Okay, I think that hush means that we're ready. Hello, my name is Soumaya Keynes. I'm an economics columnist at the Financial Times, and I'm delighted to introduce this panel about the neutral rate of interest, or R star. R star is my favorite of the R's, and it is perfect for a columnist because you can talk confidently about it and no one will ever really know if you're wrong. So we have the perfect panel. We have Catherine Mann of the Bank of England. We have Maurice Obstfeld of the Peterson Institute for International Economics. And we also have Silvia Ardagna of Barclays. I really don't plan on doing a huge amount. We're going to hear from the panel. We'll have a bit of a chat between us, and then we're going to open the floor to questions from you. So please do get your most piercing questions ready. And yeah, with that, can I invite Catherine to give her opening remarks?
So Soumaya introduced this panel as being the neutral rate of interest, and she said R star. Well, in fact, we could go and add more definitions. The natural rate, the terminal rate, the equilibrium rate, big R star, and little r star. So many more ways in which we can define whatever it is that we're going to be talking about here. Now, the issue here is, of course, that these definitions, depending on who's using them, mean different things. And so there can be talking across purposes. There can be different ways of measuring them in the market. And there certainly are differences in how various people on the Monetary Policy Committee and in the central banking community more generally might be thinking about the neutral rate of interest. For my decision making, and all these slides are on the website now that I'm speaking, for my decision making, the neutral rate is the short-term rate at which the economy is neither stimulated nor contracted within the monetary policy horizon. So let me give you a picture of that, okay? So what you have in this picture is a variety of different measures of the neutral rate, or R star, or equilibrium, or terminal. The aqua line is long-term neutral. This particular chart is in nominal space, but I could also draw it in real space, as some of the other people will be doing. There is the bank rate, or the policy rate, which is in purple. And then there is this short-term neutral that rolls around or goes above and beyond the long-term neutral, but nevertheless is, for me, the relevant measure of restrictiveness or degree of accommodativeness for monetary policy decision-making. So moving on to measurement. So we're going to have an equation here that I'm going to skip through, but we're going to end up with a variety of different variables that are relevant for considering how close we are to the measure of R star. So we can do the math, which I'm not going to do, but is on the website. Whoops, skipped one. At the top there we go. At the top there is how one can define algebraically R star and degree of restrictiveness. In real space, we've got real R minus whatever R star is, and that is equal to the nominal interest rate gap, which is whatever I star is, and the interest rate that we observe. And then there's two expectations. One is expected pi star, and one of them is the expectation for inflation that we can get from survey data. So the point here is that the real rate gap, the one that is a measure of real rate restrictiveness, is not observable. A lot of people have talked about that. The policy rate, which is I, although I would also argue that I can also be thought of as financial conditions, which is, of course, much more extensive than my decision about policy rates. But I don't know what I star is. It has to be measured. And then lastly, these two inflation components, in some sense, the expectation of pi star is predetermined in that it's the remit that is given to me as a monetary policymaker of 2%, but expectations are not known and they need to be managed. So let's look at some of the ways we can measure the things that we don't know, but are pieces of the real rate restrictiveness that we would like to be able to observe and have a handle on in order to evaluate the degree of restrictiveness of monetary policy. So this is a measure of the difference between policy rate and one measure of the expectation of, in this case, our MAPS survey respondents in the financial markets. So they have their so-called terminal rate or nominal rate or whatever they want to call it, and it's approximately equal to 3.5%. This MAPS information is on our website, so you can go look for it yourself. And you can see that their view of what the nominal rate is going to be, that's their view of the policy rate, approaches their view of what the neutral rate is within the forecast horizon. So the nominal rate gap, which is one piece of the real rate gap, is approximately going to be 0 within the forecast horizon. Now, what that could mean that we're all in good shape and the Monetary Policy Committee can proceed with following that nominal path that MAPS has and be assured that we will achieve our remit of 2% in the medium term. Now, the questions that I think are relevant to consider here is, these are the averages within the MAPS survey. And if you, in fact, look at the distribution of the MAPS respondents, they all have that neutral rate and nominal rate are upward biased. So there's a inflation premium or risk premium or some premium in there that is important to consider when evaluating whether or not we actually have closed in expectation over the next couple of years the nominal rate gap. The second piece here is the inflation drift parameter. I call it drift because there certainly are times when expected inflation does deviate from our remit of 2%. We can look at household expectations, for example, or we can look at other measures. And this one comes from asset implied probabilities of being lower, around the target, or higher than CPI 1 year ahead. The colorful chart here and the time series, which goes back to 2004, indicates that this drift does have relevance for considering in the monetary policy horizon. With the last 2 years, quite a bit of a variation in how much expected CPI inflation outcomes deviate from the 2% target. So we cannot be assured that drift is constant over time, and therefore we can ignore it when evaluating the degree of restrictiveness either in nominal or in real terms. Lastly, the real rate gap, which is kind of the thing that we would like to know more about. Again, we can use several different measures of expected inflation in order to evaluate what different economic agents think are the probable real rate gaps looking forward. It's important to note that some of these vary, well, they're all different. Some of them vary over time. So again, we cannot be assured that using a measure of expected inflation is going to be necessarily the right measure of expected inflation when determining the real rate gap or the nominal rate gap. The last point I want to make is that in many of our analysis, and in fact in what I've showed you so far, except for a couple of them, we're using means as opposed to the whole distribution of analysis in order to evaluate what these gaps are. And I would argue that understanding uncertainty and volatility and risk premia are key ingredients of determining the degree of restrictiveness of monetary policy, either in real rate terms or in nominal rate terms. And you can see how I've differentiated my terminology about uncertainty, about which we've heard a number in the earlier panels, is a real side concept. We can think about it affecting consumption and investment and reducing R star, the real rate R star, through that channel. Volatility, which is a sigma term for inflation, it's a distribution of inflation, is positive. I gave a speech on the Great Moderation, or the end of the Great Moderation, indicating that when we have higher volatility in inflation, it is associated with an upward inflation bias, and that would be associated with me raising my nominal R star, or I star, my policy rate. And then finally, higher risk premium in financial markets has to be priced in. Somebody's got to pay for volatility. And that is something that will show up in both the real R star as well as nominal R star, nominal I star. As an indication of just what some of those volatility measures market that is going to be relevant for the premia that are in the various stars, and therefore the measures of restrictiveness. But these volatility measures are also relevant in spillover sense. This decomposition of the market behavior into these components of policy, macroeconomic environment, and UK-specific risk show the degree to which it is important to incorporate volatility terms in and spillovers, cross-border spillovers, in our own assessment of what the degree of restrictiveness is and in the potential for risk premia to be incorporated into that degree of restrictiveness. So how important might that be? Last slide. I think that's the last slide. The last slide is, suppose we do underestimate real R star, the real rate at which there is an equilibrium between supply and demand in the very long run, or the degree to which there is risk premia incorporated into the real rate that equilibrates the market in the monetary policy horizon. It matters a lot for our estimation of restrictiveness. What you have here in the white line is a financial conditions index, which incorporates the R star that is embedded in our forecast infrastructure. If you instead take that same financial conditions index and only adjust it for what MAPS says is their R star, which I showed you at the beginning of the presentation, you get quite a different view on what is the degree of restrictiveness. By using a higher R star, the degree of restrictiveness of monetary policy is much less. So my conclusion is we need to be considering real rate gaps, nominal rate gaps, and inflation expectation drift. And only if we evaluate all three of those in conjunction with each other, not just in means, but also in distributions, only after that can we really understand the degree of monetary policy restrictiveness at any point in time and the importance of that for the monetary policy horizon. Thank you.
Now, by showing these rates, I don't give you direct evidence about R star, which, as Catherine pointed out, might be the rate appropriate for a non-inflationary monetary policy. It might be a long-run rate estimate. But these are very much correlated with R star, so they are very relevant data for us because over this period, we didn't see a lot of inflation for the most part. We could talk for days about the trends driving this. Charles Goodhart, who is here, has a great book about that came out in around 2020. But recently there have been changes, and particularly with the inflation surge that we saw in 2021, 2022, central banks raised interest rates to contain inflation. They certainly made the assessment that R star had risen. And not only have real interest rates remained higher, even very long-term measures of real interest rates have remained higher. For example, if you look at indexed bonds, whether these are UK 10 or 30-year gilts, or German 10-year bunds that are indexed, or indexed US tips, the rates are quite a bit higher. For US 10-year tips, they're around 2% now, which is a far different number than what we had gotten used to in the aftermath of the global financial crisis. If we try to actually estimate R star, this is a tremendously difficult task. Central banks try to do it. Most central banks have multiple ways of doing it. And a great embarrassment, I think, in trying to make R star the sort of North Star of monetary policy is that these estimates tend to diverge quite widely. The chart I was... The slides back? The slides are back. Okay, great. Thank you. Okay, well, let me turn without ado to these estimates. These estimates also illustrate that how you estimate depends on perhaps a different question that you might be asking. So these three estimates are a estimate derived from the term structure, and these are just for the US, by the way. The term structure of index bonds yields. This is a work at the Fed by D'Amico, Kim, and Y, and they look at a 5-year forward estimate that they extract from a term structure model. So here they're trying to actually get away from term premia or any factors that might pollute their estimate. And you can't really look at this estimate and say this is what rate the central bank should set, because it's, as it were, a kind of terminal rate 5 years forward. It's an estimate of what would be the long-run rate that the market expects in 5 years. And there's actually some peril, as Kathy hinted, in moving from market expectations to thinking about what the central bank should do, because market expectations depend on what markets expect the central bank to do. But this is one possible measure. It's way below the red measure, which comes from the Richmond Fed and is based on a time-varying vector autoregression with a number of variables. And again, they look at a very, very long-run forecast of the real interest rate, and they say, well, that's the equilibrium terminal rate. And then the lowest version is the Holston-Laubach-Williams quite famous methodology, which is quite different. It's actually sort of looking at what is the rate historically that would have given you a zero output gap and a zero inflation gap. So navigating this terrain is very difficult for central banks. And in fact, when central banks judge that policy is restrictive, model like this might be an input, but they're looking at a range of soft data and hard data from the market. And it's well that they do, because their job is very, very hard. Now, in the integrated world equilibrium I showed you, there are basically two countries. But in fact, the movement of capital around the world is not unimpeded at all. And an interesting question is, what is the role of emerging markets? Emerging markets are increasingly important. China, first of all, but not just China. And interestingly, if we combine my 12 advanced country sample with a sample of 23 emerging markets and look at average real rates, you find that they cohere pretty well together until shortly after the global financial crisis. Then they diverge. Emerging market rates rise above rates in the advanced world, and they remain persistently higher. And we don't really know why this is. I mean, one hypothesis would be more limited balance sheet capacity in advanced country financial institutions after various financial reforms, but this is an important topic for research. And it indicates that if you're an emerging market central bank, your policy rate is likely to be higher than in richer industrial countries if you are an inflation targeter, which increasingly many of these central banks are. Nonetheless, if we ask what is the main driver of industrial country real interest rates, it's likely to be flows between the industrial countries. And what this chart, which is 2023 data, indicates is that the main counterpart to the US deficit, the huge US deficit, which is motivating the current tariff war, is surpluses by other advanced countries. China, to be sure, has a surplus, but it's only about a third of the US deficit. So what's happening in advanced countries, I would argue, is the dominant factor right now for global interest rates. And going forward, they're likely to be higher, I would argue, because of developments like the need for more military spending, the need for higher deficits, possible developments relating to AI. So let me just wind up here with some takeaways. Even at longer horizons, real rates are not equalized across countries, perhaps puzzlingly so, given the degree of financial integration. And if you're looking at short-term real policy rates that keep inflation in check, the divergences are likely to be even lower, even bigger. Index bond markets, even at very long term, show large gaps, which are somewhat puzzling. And everywhere, global events are going to influence the domestic R star. One point that I would emphasize that I haven't gone into in detail, but I think is very important, is that in thinking about where your R star is, you need to think about the external balance. You need to think about where your current account is, at the very least. And that brings in the issue of the real exchange rate. And it's likely to be the case that there's an equilibrium real exchange rate that corresponds to the equilibrium R star. For example, if you have a surge of capital inflows that appreciates your currency, that's going to have a potentially contractionary effect that tells you that R star should be lower. So these are just a couple of observations on how the international scene matters, but it is an important margin to take into account. Stop there.
Good afternoon, and thank you very much to the organizers for having me be part of this extraordinary conference and panel. Obviously, after Maurice and Catherine, there is not much I would say that I can add in terms of explaining R star, both from a theoretical point of view and in terms of implication for monetary policy. But I thought that even with all the uncertainty that we know that there is around R star, almost quite a mystic concept, we might want to look for some framework that could allow us to say perhaps something about the really truly underlying determinants or what we think they are. So in my presentations, I will try to do two things. First, I will try to say something or where perhaps R star could go, let's say, in the next 10 years. And so to Soumaya's point, I'm even less likely to be wrong, because in 10 years, maybe we're not going to be here to hold me accountable for that. But I will focus on some of the very underlying trends of our star, and I will focus about the demographic drag, what that could imply for our star. The productivity bounce back, if there were to be one, how big could it be to basically compensate for the offset of the demographic trends? And third, I will speculate a little bit on the supply of safe assets, what that implies for our star. And in the final part of the presentation, maybe I'll say something more for the people that are on the private sector like I am now. That is, we often are obsessed about this concept of neutral rate, R star. Maybe, as Catherine was saying, okay, maybe we should think a little bit about more the relationship between neutral rate and terminal rate, and I'll show you just a little bit of data on the relationship between the two. Now, let me start with the first part. I will actually just, very important to say that obviously there is a lot of model uncertainty around our star. We all know that there is very much uncertainty whether we are looking at actually, even within the same model, at estimates that are ex-post estimates versus real vintages and real-time estimates. I will just do the analysis using one framework, and this is the paper by Ferreira and Shusha that has just been very recently published on the Journal of International Economics. This is a state space model that estimates our star for 11 developed countries as a function also of some of the exogenous underlying structural factors. So just to show you, again, if you take the R star estimates for the Euro area, the UK, and the US, at least you can say that these correlate pretty much with what Maurice has shown. So there is a downward trend when you start looking at these R stars since the 60s. And then their models basically estimates that there has been a recent pickup in R star. So let me show you what are the factors that have determined this pickup in recent time for our star. Now, if you look at the decomposition of the change since 2008, you can basically see that most of the factors, which are basically working age population, productivity, the supply, the demand of safe assets, are basically pushing R star to the downside. The only factor that has pushed in this model the neutral rate up is the supply of safe assets. And in these particular estimates, the supply of safe assets is basically the supply of marketable US treasuries. So basically the amount of US treasuries that is available for the private sector, for the marginal buyer. So it's netting out the intergovernmental and central bank holdings. So basically, this has been the only reason why in this model we can see the recent pickup. Now, let me look into the future. So let me start by, again, if there is something that we can say with some degree of certainty where it is going in the next 10 years is really the share of the working age population. We all know about a demographic the population basically aging. And over the next 10 years, this phenomenon continues to be pretty sharp on a declining trend in the Euro area, while the amount of the declining is quite low when you look at the US and when you look at the UK. Before I go on, sorry, I forgot to tell you what the global spillovers are and how they're measured. I mean, think of them, they're basically a weighted average of the working age share in this model and productivity dynamics weighted by the trade share of each country vis-a-vis the others. So if you look at this chart, you can see that basically over the next 10 years, we are going to have a decisively still declining in these estimates of R star for the Euro area, which is coming from its own demographic shift, but that this demographic shift is also going to have a spillover, a negative effect to the UK and to the US, even though the amount of the demographic shift in this country is going to be less remarkable than the one in the euro area. Now, in the second slide, we often hear, okay, maybe R star is reason because of many factors. And obviously, it is hardly often said reason relative to which time period, right? Maybe, okay, reason relative to the global financial crisis, but, you know, it might be interesting to know how much it will rise more relative to where we are today. So again, from demographic, we learn it's not going to rise, most likely. I asked, you know, the question using this model, by how much should productivity bounce back to at least compensate for this drag that is coming from demographic? And here, you know, the bounce back of productivity that we are simulating is quite a large one, because it basically, as you can see from the dashed lines on to the chart on the right-hand side, it basically implies, if you think that productivity would go up to what it was pre-global financial crisis, is about, you know, 50 basis points per increase in productivity in the US and in the UK. Smaller in the euro area. But even with that big bounce back, for example, you can see that the R star estimates from this model in the euro area, it's not going to be anywhere enough to compensate for the drag from demographics. While for the US and for the UK, because the productivity bounce back is large, you are going to have a more notable impact on R star, even though, again, the demographic pushes in the other way. Now, the other reason that we often hear that, again, R star might be higher in the future than it was in the past, again, whatever past comparison you take, is that this upward push that the supply of safe assets had since the global financial crisis would continue. Now, obviously, if that is measured as, you know, the amount of debt security that, you know, some safe asset that will be available, we know that debt to GDP ratios are increasing, so you might, you know, think that this will continue. Again, perhaps never than in the past few weeks, we already had a sense of, you know, what can be safe today. We have been reminded of what can be safe today might not be safe tomorrow. And here what I'm plotting on one of the charts is really the supply of all AAA securities and how that developed since the mid-80s. And again, depending on, you know, the sample that you take, depending on whether you want to take, you know, securities that are rated AAAs by all the rating agencies or only by one, you can see that there have been a pretty sharp decline in one definition of the supply of AAA securities around the global financial crisis. And clearly that has to do with what happened, you know, with the euro debt crisis ahead of it. I mean, for those who don't remind it, for me was also a shock when I look at this data. For example, you know, in 2008, still Ireland and Spain were rated AAA by all the major three rating agencies. It took 2012 for Ireland to pull out. So again, now we might think that US Treasury securities are going to, you know, continues to increase, but perhaps we have to think that, you know, R star can, you know, the supply of safe assets is also a dynamic concept, and so R star. If there are financial stability concerns linked and issues linked to the change in nature of a safe asset, the R star definitions might look different. Now, let me close with the last part that is more for us, for the practitioner. And again, sometimes we are very much worried about, you know, neutral rate, because we would like to know what is terminal, right? Where is the central bank is going to put the policy rate for us to have the, you know, the best trade, in a sense, to go forward. And here what I just did, I simply compared the nominal terminal rate, the nominal neutral rate implied by this model in all these 11 countries from the 2000 with the terminal rate at the end of the various easing or tightening cycles, and take the spread between the two. And obviously, you can see that these two distributions are very asymmetric. They certainly are not centered around zero. So most likely than not, central banks cycles are not going to end in what are our estimates of neutral rate. It seems that there is a higher probability that in easing cycles, central banks are going to ease more than what this model would tell you neutral is. And in tightening cycle, the opposite is happening. So to conclude, again, on the two questions I try to focus on, when we think about, even within all the big uncertainty that there is around R star, I think that when we think about the determinants, the slow-moving determinants of the global neutral rate, it seems to me that demographic shifts are pretty dramatic, particularly in the euro area. And so it is, it would require a pretty large bounce back in productivity, even to keep the neutral rate at levels that we are currently seeing. Most likely in the future, it could go down. The evidence seems to be much less clear-cut, all else equal, if you just focus on demographics and productivity for the UK and the US. Second point, be mindful of what a safe asset is and how, multiple equilibria and non-linearities can really be very relevant in this concept. And finally, perhaps for us in markets, focusing on terminal could be best than focusing on neutral. Thanks.
Great. Well, thank you so much. Okay. Well, we've heard a lot, and I think one of the messages coming out of all of this is that R star is hard. It's very, very difficult to observe this thing and to know what it is. But I want to try and get more specific about, ideally, pick a definition and where do you think it actually is. And then in one of Silvia's slides, we saw this model was setting out how it might have changed, between 2019 and 2025. I think the range was between 0.4 and 0.6 percentage points for the US, Euro area, and UK. So I want to kind of get your sense of whether you think that's about right in terms of the recent shifts of R star. Catherine?
What I took away from the two other presentations was the focus on long run, real equilibrium, savings equal to investment. And the point that I was making is that's all very interesting, but it's off stage for me. My monetary policy horizon is 3 years. I face a tremendous amount of nominal activity and nominal changes and nominal transmission of my nominal policy rate to the economy. And so quite a bit of why I focus on these different measures of the real rate gap, the nominal rate gap, the inflation expectations gap, is because all of those things are important to me over my monetary policy horizon. It's true if I never had a deviation from target, in other words, expected inflation equal to my target, then the real rate gap and the nominal rate gap are the same, and a lot of problems go away. But that has not been true, and I don't expect it to be true going forward, because volatility in particular, and risk premia, volatility and its implications for inflation, and as it is observed in financial market risk premia, are going to be part of my environment of monetary policy making. So I can't sort of assume away the annoying things that make the real rate the focus of a theoretical exercise. I'm sorry.
That's okay. I mean, is there any use in talking about R star and rather than just the appropriate rate of monetary policy?
Absolutely. I think it's very important to take from financial markets and from businesses and households what they observe in terms of their degree of restrictiveness. So there's a tendency to look at these gaps and say, those gaps are going to tell me about restrictiveness. I think those are, what I look at is the outcome of monetary policy stance as it is transmitted through financial markets, which, by the way, are global, absolutely, and are affected by other actors out there who are contributing to financial assets. And I have to take those and reflect upon what are the outcomes in terms of restrictiveness, the inflation process, the degree of economic activity. So it's the outcomes of restrictiveness as opposed to measuring restrictiveness per se.
Maury, can I pin you down any further on recent changes or levels of R-star?
So you want a number?
Yeah.
President Lyndon Johnson was once asked his economic advisors a quite numerical question, and they gave him a range of numbers, and he responded, ranges are for cattle, damn it, I want a number. So I think you're being Johnsonian here. Okay, but I'm going to revert a little bit to Kathy's dodge here to first make a conceptual distinction. I like to distinguish personally between the neutral rate and the natural rate. I think the neutral rate is the rate at which monetary policy becomes restrictive. If you're facing an inflation surge, you want to know where that is. It can differ a lot from the longer run natural rate of interest, the sort of equilibrium rate. Just to give you two examples. One is the state of market expectations. If you as a central bank have lost some credibility and the market is looking for a statement that will help contain their inflationary expectations, then your neutral rate is going to be higher than otherwise. You might have to make that statement through a high interest rate. Another example is financial conditions matter. I would argue that in the US, the Fed's policy from 2022 on was probably less restrictive than the Fed thought because of financial conditions that had built up during the pandemic and before. Incredibly low interest rates during the pandemic. A lot of households refinanced mortgages at long term at very low interest rates. A lot of corporations did the same. That had the effect of making the transmission mechanism of the policy rate less powerful, and says that if you want the same bang for the buck on inflation, you need a higher policy rate. At any point of time, it's really hard to say whether policy is restrictive or not, and all central banks are basically feeling their way at some level. I would be more adventurous about the natural rate, where that is right now. I think for the US, somewhere between 1% and 2%, probably closer to 1%, is probably a good estimate. It could be going higher as federal debts pile up. It could be driven higher by events in Europe as Europe rearms and builds a local arms industry. So I think this is all in flux. Probably the rate is somewhat lower in the EU, in the euro area for now, but that could change if there's a fiscal expansion in Europe. And I think that the possibility that particularly that interest rates are driven up by debt is very worrisome for the world, just to bring it back to the morning's discussion, because governments had it easy with very, very low interest rates for a very, very long time. They've built up higher debts post-COVID. The inflation surge was helpful in a perverse way by reducing the real value of those debts. The debts have continued to rise, and if in fact real rates, equilibrium real rates, rise a lot, fiscal sustainability is going to come even more into question than it is now. So I don't know if that answers your question, but
close enough. Silvia, can I ask about communication when it comes to R-star? Do you think that that central bankers could do should communicate more when it comes to their estimates of where it is?
No, I I think again, depends on which R-star you are thinking about. I think it is obviously a useful concept if you think in terms of, the natural rate, right, and the very long term as a reference of where things could go. In terms of the more short term, what market would like to hear, again, obviously markets would always like to have more and more in terms of communication, but sometimes maybe too much might become, again, too much of a constraint, or too much might become even less clear, right? Because then when things change, imposes constraint and makes difficulty. I think what is more important is to communicate your framework in a better way, rather than just the R-star. I think we all understand the uncertainty that there is and how difficult it is to evaluate it in real time. So, okay. I don't think that there could be a world in which you can be so clear in terms of saying, okay, this is going to be my short-term R-star for the next 2 years or 1 year. To the extent that perhaps ex ante we would love to have, but it might be quite complicated.
Okay, well, now I think it's time to open it to the floor. So I'm going to take 3 questions at a time. Can we have Catherine? And then.
Hi, thank you. I can't resist asking a question about R-star. So I'm
so sorry. Could you also introduce yourself?
Sorry, yeah. Catherine Nice, PGIM Fixed Income. So my question sort of relates to this discussion we're having about R-star, to what's happening right now, and it's linked to some things that you've shown us in these charts here. So I think coming out of COVID and the energy shock, one thing that we've seen is it looks like R-star has risen. So the question I have is, what are the panel's thoughts on the impact of trade wars on long-term R-star, and in particular, coming to the point that you, Maury, were making about spillovers. If that leads to less integration, more financial fragmentation, could that affect spillovers? One question I get asked quite a lot is, how divergent could, for example, monetary policy in Europe be versus the US? And I think at the heart of that question is some of these issues around financial integration. Thank you.
Thank you.
We've Dick Berner, NYU Stern. So we've actually heard a lot about frameworks this morning, and Silvana just mentioned that maybe we should hear more about that and more clarity about that. That sounds reasonable. Actually, R-star is incorporated in one version of framework, namely policy rules like the Taylor rule, for quite some time. And I'm just wondering how the panel is thinking about being clearer about policy rules, or whether or not they're useful in articulating the stance of monetary policy.
Great.
Good afternoon. Brunello Rosa, Rosa and Rubini Associates, and London School of Economics. There has been a couple of publications from the Fed and ECB on the effects of the convenience yield on R-star. Most recently, Ms. Schnabel from the ECB talked about it at a research conference at the Bank of England. I wanted to know what was your thinking about that, possibly related to the fact that Silvia spoke about, which is the availability of safe assets, somehow also related to, I guess, the financing of large deficits and therefore the issuance of debt. Thank you.
Great. Okay, so we have 3 questions. Trade wars. Could there be sort of decoupling of rates in advanced economies? Maury, do you want to start with that one?
Yeah, I mean, I think that the trade war issue raises a lot of difficult questions for central banks if one is talking about R-star and about monetary policy. First of all, there's generalized uncertainty, and we know that uncertainty leads people to seek safe assets. In the present context, however, the safety of U.S. Treasuries has come more into question. What we've actually seen is higher rates in the U.S. and these, to some extent, I think, propagate abroad. These are all short-term developments. Longer term, I think there is a definite risk of financial fragmentation, which would lead to more divergent behavior of R-stars across national boundaries. There are a number of mechanisms that come into play. I worry about the breakdowns in international financial cooperation, which might lead countries to try to segregate their capital markets from divergently regulated financial players resident in other countries. I worry about explicit taxes on transactions that might come into play. I worry about countries just trying to insulate themselves from sanctions that foreign powers might levy. So I think all of these things are very, if not likely scenarios, they're not implausible scenarios as we move through, a very evolving set of international conflicts over commercial policy. And these would allow more divergence in policy settings, but at a cost of the gains from financial integration.
Catherine, which one did you want to take? Policy rules, we've got convenience yield, or also trade wars?
Right. So I think for each one of these questions, I would come back to a point that I emphasized, is that not only can we talk about how they changed potentially the mean, trade wars, reducing productivity, reducing mean R-star, but increasing volatility in cross-border financial flows as well as trade flows, creating arbitrage opportunities for firms to seek out higher yields. All of that type of volatility increases the policy rate, I-star. So you've got two things going on the real side and on the nominal side that can, it's unlikely that they're going to counteract each other. The same thing is true for a policy rule. Most of the policy rules are done in mean space. They're not done in distribution space. It's much more challenging to incorporate the distribution of activity, and inflation can be done, obviously, but to do that with sufficient sort of real time, so useful in a policy rule environment. We do have our internal ways of looking at this, and again, they are less focused on the distributions around the mean than I would argue that they need to be in an environment where more volatility is most likely the rule, not less volatility. And in terms of the safe assets and convenience yield, well, the variety of buyers of safe assets aren't so much in the marketplace anymore. And that means there's plenty of availability out there, and what will be the consequence of that for policy rates is to be considered.
I mean, when I think about the trade wars and R-star, I think online of what Maurice said, I also think, Catherine, that if we believe that trade was also a vehicle for increased productivity across the world and TFP growth across the world, both in terms of maybe not just innovation but adaptation of what you have, that clearly would be a setback. And so I would think of it as being a negative determinant for R-star in the longer term. Also, if during this transition we think about financial stability consideration. I think Gianluca Benigno and co-authors have these papers in which they try to look at, the R star that is, that would be implied once you consider also the financial stability consideration.
R star.
Exactly, R star. Then that would also, I say, push in along the same direction. On policy rules, maybe for Europe, I find it very interesting what the chief economist of the ECB says at the current juncture. Perhaps thinking about a rule in changes rather than in level, right, is what, at the ECB was the old Orfanides type of rule. It might be useful because, again, to set up policies in the shorter term, you are getting away in this way from, pinning down the level of R star, but you are able to understand, say, you want to reach inflation, a target over the next 18 months, 12 years, 2 years, by how much do I need to change my interest rate to keep it there?
Okay, great. Can we have another round of questions? Jumana and one and huh?
Thank you. Jumana Salihin at Vanguard. I'm just wondering, are we complicating matters, talking about all these different concepts? At some horizon, they're all going to be the same, right? If you get rid of rigidities, I think we're really complicating it. The Bank of England watchers, what they really care about is when interest rates are cyclically high, where are they going to settle? Is that going to be settling at a higher level than where they were in the past, right? So it's actually really simple. What watchers care about is where are rates going. You've got the cyclical, you've got the structural, and what they care about is the structural. And I wonder if there's a disconnect. Catherine Mann has been talking about, the horizon at which she thinks about 2 years, 3 years. Is there, therefore, a disconnect between that and the more structural factors that, other panelists, Maury and Silvia, you've spoken about demographics, trade. We've seen those long-term trends. And where does that all come together? Should we be thinking of something like the Fed, where in their dot plot they do signal where that longer run rate is going to be?
Great.
So Jakob Lauer from Handelsbank. Yeah, I can hear from Handelsbanken. So it was very interesting to see this sort of difference between sort of advanced economies and emerging economies, and the sort of difference in their when we talk sort of the long-term interest rate there, and in particular the divergence that we saw after the sort of financial crisis. So it would be more interesting to hear slightly more on what is the sort of more of this origin of this difference, and what sort of reforms have led to it.
Thank you, David Whittaker from Starling Bank. I had a question about one of the charts that I think Maurice presented with the different estimates for the real neutral rate. I wondered, is there ever a situation where there become too many diverging estimates for R star, and does that make policy making actually more difficult? And secondly, has it been helpful to understand the effectiveness of policy retrospectively by having these increased numbers of estimates for R star? Does it help from a kind of historical understanding perspective? Thank you.
Okay, great. So we've got a question on, are we complicating things? Do we need to simplify? And then, is the complexity actually helpful? And then kind of, origin. I didn't actually catch origin of differences for what, but I'm hoping that you did. Okay, great.
Yeah.
So I'm just going to, Catherine, should we start with you and then we'll go down?
So I think it is interesting. The first chart that I presented had the long-term, the trend in the real R star, trending downward, which would be consistent with Silvia's presentation and what you saw from Maury as well. But it also showed the short-term dynamics. I spent a number of years in financial markets as global chief economist for Citibank. And I can tell you that they were really interested in the cyclical. And that's where they made all their money, was on understanding the cyclical behavior of the policy rate. And so when I talk about how that is important to me, it's in part because I know that the cyclical dynamics of my policy decision is relevant for financial markets. And given that they then react as well as the real economy, it means that both I and R star are endogenous to my policy decisions. So I guess I think that both the real economy and the financial markets care about both the long run, as well as the structural, as you say, as well as the short run cyclical. I think you cannot ignore either one of those. Having a dot plot, well, we get to talk about R star in each one of our speeches here at the because of our individual accountability. I have indicated my numbers before, as well as some of my colleagues have as well. Are there too many estimates? There are a lot of concepts, and we've heard several amongst ourselves, and there are other ones out there. So if we could all agree on exactly what it was that we were trying to measure, we would probably get to one concept. But until we get to that point, I think there's going to be a lot of concepts out there and a lot of measures for it.
I'll pick up from that. I think I agree with Kathy's assessment. I don't think you can. I mean, it's easy to say there are too many estimates. It's confusing. Let's settle on one, but we really don't know what is the right one for what purpose. So I think it's useful to have these estimates through different methodologies. You can try to test them within models to see how they perform, and this is a strand of the literature that's been fairly useful and from which we've learned something. And I think we also want to know about the future. And even if you don't think it's important for monetary policy, I think it is important for monetary policy because the stance of monetary policy depends, the effects of monetary policy on inflation in all of our models depend not only on the rate you set today, but the rate that markets expect you to set in the future relative to the equilibrium rate in the future. And so the real world is complicated. I think we can't simply wave that away when we try to set monetary policy. Regarding the EMAE divergence, I mean, probably the more surprising thing is how close these estimates were up until the roughly 2012 or so, and I would attribute that for the 2000s to an environment of incredibly high liquidity in the global economy, which ended in tears with the global financial crisis. Afterwards, we have massive QE in advanced markets, many advanced markets driving capital to emerging markets, with them complaining about appreciating currencies and currency wars. And that eventually comes to an end as prospects for emerging markets start looking a little more cloudy. And as I think institutions, financial institutions in advanced markets start feeling more balance sheet constraints. And the situation we have now reflects a more limited capital flow to emerging markets. At some level, that's a distortion, but at some level, it also reflects the institutional capacity in many of these markets, which is just weaker. And it's one hesitates to generalize. I think to really understand the spreads, it's really a country-by-country exercise.
I think on the different models, different estimates, do we complicate? I think simplicity is very welcome, but not if it becomes simplistic, right? I think it's very wise to have different models, different frameworks, to the extent that help us understanding a very difficult world. And maybe it's more up to us how do we interpret these models and how we use them, right? If we see them as a framework and we know how to understand them, that's helpful. It's not something that we should just have one number because that makes our life easy if that number is completely wrong, right? So that I actually appreciate the variety, and from my point of view, at least, I find it very helpful when researchers that have the time to do it in a very deep way also share with us their code, their data, their analytics that allows us to play and better understand what's going on. Maybe on again. What has happened, somebody asked what has happened after the global financial crisis vis-a-vis us, why this R-star is now drifting. Well, I guess there is a bit of evidence in economics research, quite a bit of evidence that obviously the recovery after global financial crisis, after financial crisis are very slow. And obviously after the global financial crisis, the saving, right, the imbalance between saving and investment was persistent for quite a long time. So perhaps now finally we are, out of that, and that's why that could be one factor that explain why these estimates of R-star are pointing to the upside.
Okay, great. I'm going to do something very risky, so everyone's going to have to be very careful, but we've got 3 minutes left. I think we can fit in maybe 2 more questions if you all agree to answer them quickly and you agree to ask them quickly. Okay, we've got 2 down here.
Hi, Phil Aldrich at Bloomberg. I hope it's a quick question, a quick answer. The Bank of England currently has in its says that monetary policy is restrictive. At what point will interest rates be when they stop using that language?
Very good. And then, yeah.
Hi, Marica Cioffi, Banca Italia. So Silvia, you showed that to compensate the negative effect, demographic effect on productivity, on the R-star productivity would need to bounce back by remarkably. So do you have in mind, or what's your view, and also the panelist view, or what could be the driver of such productivity increase? Because of course, depending on the driver, it also can tell you something on the likelihood of this bouncing back.
Perfect. Okay, great. We've got 2 minutes. Do you think you can answer in that time? Catherine?
When will we stop using the restricted language? When it's appropriate.
Thank you for that. Really giving exactly what everyone wanted. Maury?
Sorry, well, the other question is directed to you, so I'll turn it over.
If I have to do a quick one, there was lots of hope on AI at the beginning of the year. Let me take that. Hard to say what could be the driver. Hopefully, again, this morning somebody was mentioning, obviously, the positive impact that in some cases research and development has had from spillovers from defense. Could that be a case? Could less regulation? Again, there are many determinants. What is likely to happen in the next 10 years? Yeah.
Marvels of cryptocurrency.
Well, that I wouldn't, it didn't come to my mind.
Okay, great. Well, I think I might wrap things up here. R-star, no one really knows what it is. Perfect subject for a column. I still don't really know what it is, but there are lots of different versions. So that's a good thing to leave us with. Thank you so much, and have a great rest of conference.